Imagine it is a Tuesday morning. You wake up, check your phone like you always do. But this time, your portfolio is down. Not a little, a lot. Red numbers everywhere. You scroll the news. Tariffs, recession, market crash. The headlines are screaming, and your stomach drops with them. Your finger hovers over the sell button. Just get out. Your brain says, stop the bleeding. You can always buy back in later, when things calm down. So you sell. You feel relieved, safe, smart, even. Then 6 months later, the market has recovered, and you are still sitting in cash, too scared to get back in, watching the gains happen without you. You did not protect yourself from the crash. You were the crash. My name is Webb. Webb Finance exists to show you the financial mistakes that feel like the right move in the moment, and quietly destroy your wealth over a decade. If you have opened your brokerage app more than twice this week just to stare at the numbers, this video is for you. Hit subscribe. Because today we are going to talk about panic selling, the most expensive emotional reflex in personal finance, and exactly what is happening inside your brain when the market turns red. Here is what most people do not understand about the stock market. It does not reward the smartest investors. It rewards the most disciplined ones. Warren Buffett did not build $100 billion by timing markets. He built it by sitting still, while everyone else panicked. That sounds simple. It is nearly impossible to actually do, because your brain is working against you. When your portfolio drops, your brain does not process it as a temporary fluctuation. It processes it as a threat. The same system that kept your ancestors alive when a predator appeared activates when you see a red portfolio. Your body releases cortisol. Your thinking narrows. You want to act. Any action feels better than sitting still while you bleed. This is called loss aversion. And it is the most well-documented bias in all of behavioral finance. Studies show that the psychological pain of losing $1,000 is twice as powerful as the pleasure of gaining $1,000. The market goes down, and your entire nervous system says, get out now, but the market does not care about your nervous system. Let us look at the actual numbers. If you invested $10,000 in the S&P 500 in 2004 and left it completely untouched for 20 years, you would have ended up with roughly $72,000. If you missed just the 10 best trading days in those 20 years, 10 days out of more than 5,000, you would have ended up with $33,000. Missed 20 days, $20,000. Here is the brutal part. The best days in market history almost always come immediately after the worst days. The recovery happens fast, violently fast, and if you are sitting in cash because you panic sold during the crash, you miss it entirely. You took the loss, you missed the recovery. You got the worst of both worlds. This connects to something called the illusion of control. When markets are volatile, selling feels like doing something. It feels like a decision, a rational move. You are taking control of a situation that feels out of control, but you are not in control. You are reacting. There is a difference. A pilot does not eject from the plane every time there is turbulence. They understand that turbulence is temporary, and the plane is built to handle it. Panic selling is ejecting from the plane, and then trying to jump back in midair when the turbulence stops, which is even harder than staying in the seat was. Right now, every financial news outlet is running the same story. Tariffs, recession fears, market uncertainty. And those headlines are not wrong. There is real uncertainty in the economy. But headlines are not designed to inform you. They are designed to hold your attention, and nothing holds attention like fear. In 2009, at the bottom of the financial crisis, the headlines were apocalyptic. That was almost exactly the best buying opportunity of the last 50 years. The people who read those headlines and sold, lost everything. The people who ignored them and stayed in, built generational wealth. The news cycle and the market cycle are not the same thing. Do not let one dictate your decisions about the other. So, what does Marcus Webb say you actually do right now? Strategy 1. Turn off the noise for 72 hours. Delete the financial news apps. Close the brokerage tab. The market will do what it does whether you are watching or not. Every time you check your portfolio during a downturn, you are giving your nervous system another dose of cortisol. You cannot make rational decisions from that state. Give your brain 72 hours of silence, then look. Strategy 2. Zoom out the chart, pull up your portfolio, and change the time horizon. Do not look at the 1-week chart. Look at the 5-year chart. Look at the 10-year chart. Every single crash in modern market history looks like a small dip on a long enough timeline. The 2008 crisis, the 2020 COVID crash, the 2022 rate hike sell-off, all of them temporary, all of them, followed by new highs. Your brain only sees today. Force it to see the decade. Strategy 3. Automate so emotion cannot interfere. If you have a recurring investment setup, do not cancel it during a downturn. That is dollar cost averaging. You are buying more shares at a lower price. The crash is not your enemy if you are still buying. It is a sale. The investors who got rich were the ones who kept buying when the market was on discount, not the ones who stopped because the headlines were scary. Here is the truth about this moment. Nobody knows exactly where the market goes from here. Not the analysts, not the economists, not Marcus Webb. Anyone who tells you they know exactly what happens next is selling something. What we do know is this: every recession in American history has ended. Every crash has recovered. Every period of uncertainty has resolved into a new normal. The investors who came out ahead were not the ones who predicted the bottom. They were the ones who stayed in the game, long enough for the game to reward them. Panic is not a strategy. Patience is. Your homework. Open your brokerage account right now. Find the longest time horizon available. Look at the chart. Find every crash. Then look at where the line goes after each one. That is your answer. Do not sell the dip. Survive it. Marcus Webb, Webb Finance. I will see you in the next one.